All right, well, here we have the translation method, and then we'll go through the remeasurement method. Okay, well, when do we use the translation process? We are just seeing example after example, right? So when the functional currency is not the same as the reporting currency, and this is done at year end. Okay, if a foreign subsidiary's financial statements are in the subsidiary's functional currency, which needs to be converted to the parent's currency as per GAAP, the foreign financial statements are translated to the reporting currency, starting with the income statement. We always start with your income statement. And why is that? Because your revenues minus expenses equals net income. Net income becomes retained earnings. Retained earnings goes in the balance sheet. That's why you always start with the income statement, even in just the financial statement preparation process. Well, our first conversion, we convert the income statement. We use the weighted average rate for all of these, right? This is the whole process of translation. We are taking the income statement items. We transfer net income to retained earnings, right? Everything's in this currency now. We use the historical rate for our equity amounts, right? And we roll forward the retained earnings onto the balance sheet. We use our current year-end rate for the assets, right? Whatever that date is, generally it's going to be the year-end unless we're doing middle of the year or something. Same with liabilities. However, like I did say, we are going to use the historical rate for inventory or anything else that is valued at historical rate. Translated retained earnings, so beginning translated retained earnings plus translated net income for the current period, less translated dividends declared for the current period. This is the whole process. Hopefully it's starting to really drill down and become more clear in your mind what this process looks like, how it works. Are you going to have to do a full sim on this? Likely not. But if you understand this whole process, then it will help you answer these questions. And as I always point out, when we see them in different sections, we've got OCI. So if you've got that, you remember from your Puffer mnemonic, right? We've got translation, gain or loss. This is only for translation, not for remeasurement. Keep that in mind. Something to just take note of. So plug translation adjustment to OCI. Translation adjustment is equal to the difference between the debits and credits and the translated balance. And think about this again. OCI, these are the items that don't really reflect how a company's doing. Well, right? I mean, if you have a gain because you convert currency, that doesn't really reflect how your company's doing. I mean, you're just reporting a gain because foreign currency rates changed. And good for you. It's maybe more valuable or less valuable, but it doesn't reflect how the company's doing, right? That's not real operational profit or operational profitability.